Hello and welcome. Today we are going to be analyzing more real estate, and I have a special thing for you here. Once you hear the property description, we are not only going to be looking at how to analyze this deal using FHA loans with 3.5% down payment and leverage loans using 20% down payment, but we are also going to be changing this up because this is actually about a mile from the beach. So we are going to be looking at Airbnb here as well and looking at some potential on what can happen if you analyze this deal with Airbnb. So if you don't know me already, my name is Maxim Cruz. I am a real estate broker as well as a real estate investor. And back in 2011, my wife and I, we decided to delay our wedding ceremony in order to buy our first income producing multifamily property. That's right, we delayed our wedding in order to buy a 4-unit property, and over the next few years, we enjoyed living rent-free, getting all of the benefits from being a homeowner, getting a huge return on our investment, and then scaling up from there and buying more and more properties. So I love real estate and I love doing all of this stuff, and I've lived it and experienced it. And the reason that I'm doing this video series is so you can take a look at some of these deals, find deals in your own town, and make the decisions to go ahead and do this for yourself. So this is again a special video series for Denzel, my buddy Denzel. If you don't know who Denzel is, he is actually the king of velocity banking. So if you don't know what velocity banking is, go and check out the description below where you'll get a link to Denzel's channel, and he'll teach you everything about velocity banking. Velocity banking is a very interesting concept of how you can manage your money so you can pay off debt quicker without necessarily making more money. So it's just shifting between home equity lines of credit, personal lines of credit, credit cards, and how you move your money around in order to pay off debt quicker. So make sure you check that down below. And again, for all of our Kingdom citizens, welcome back. Thank you for joining us. Go and check out the playlist here that I have. Again, it's in the description, where if you need some help with the terminology that we're going over here, if you're just starting up, or maybe if you're a more seasoned investor, you can get caught up on that. So let's get right into it. But before we do, let me give you my disclaimer. I am a licensed real estate broker, but for this video series and for everything that you do, I don't know what your situation is, so this is not financial advice. This is for information purposes only. I always recommend that you talk to your licensed financial advisors or financial planners, because I don't know what your situation is, and again, this is for information purposes only. So now that we got that out of the way, let me tell you how this video is going to be structured. First of all, I'm going to actually break down this deal, and as you might have seen in some of my other videos, if you haven't, go and check those out. As you might have seen in some of my other videos, we typically look at 3 scenarios. We look at the listing price and what that looks like going a cash investment, 20% down, which is just your conventional loan, and also owner-occupied FHA 3.5% down. Then I show you what an offer price would be, and that offer price is pretty much based on the market value opinion that, as a broker, because we have access to what has sold in the recent few months and just what's going on with the market, we create what's called a market value opinion, and based on that, if I was to buy this property, that would be my offer, and then that is how it would look like. These numbers, again, are for information purposes only. Some of the expenses that you'll see here, again, I'm not saying those are the only expenses. You can add a lot more expenses. The income here is, again, projected income based on the information that we have. The income can be lower or it can be higher. So again, this is just a sample scenario, and let's get right into it. So after we analyze that, we are going to be looking at the Airbnb model. So again, depending when you're watching this video, you might want to fast forward all the way to the Airbnb model. And again, there'll be notes in the description at what time and seconds is the Airbnb model explained. But again, I encourage you to watch this all the way through so you can get your investor cap on and start to see what the numbers look like and what everything else is looking like here. And again, one more thing before we get started. I'd love to help you analyze any of your deals. Again, I don't need the address, I don't need the MLS number. There's only 3 pieces of information that we need. That is the listing price and the offer price that you are planning to submit on that. Next, we need the income, so pretty much what the units are currently rented for and what you expect to rent them for, and also the expenses, things like taxes, insurance, all the things that we will go here. Also, over the last 13 years as a real estate broker, I have built a huge referral database all across the United States. So even if you're not here in Miami and you need help buying these type of deals or locating these type of deals, or just working with great real estate professionals that can help you locate these deals and can help you possibly understand when you say, hey, the numbers don't work here, so I want to submit an offer on that. Again, I have a list of professionals that I'd be more than happy to refer you to. There is no charge for that. It's absolutely free. Remember, the broker's compensation is paid by the seller, so you as the buyer, you don't have to pay your broker anything because they're already being compensated by the cooperating broker. So now, after all that stuff, let us finally get into it. Today, we are looking at 317 Southeast 12th Avenue in Pompano Beach, Florida. As I mentioned, this is about a mile away from the beach. So, MLS number F like Frank 102-11433. The current list price on this property is $395,000. This property was listed on January 15th, 2020. It is broken down into 3 units. Now, I did check the tax records and it also says it's a 3-unit building, so far so good. Again, if you don't know what I'm talking about, in one of my other videos, I actually mentioned that that's one of the things you want to check, because the last thing you want to do is buy a single family home that is being operated as a 3-unit home, and the day that you close, the city inspector drives by and say, hey, you're in a single family home area, you can't do this 3-unit rental type of thing. So again, if it's listed with the tax records, the next step is to check with the city to make sure that you could legally use this as a 3-unit building. So Unit 1 is a 2-bedroom, 1-bathroom. Unit 2 is a 2-bedroom, 1-bathroom. Unit 3 is a studio with 1 bathroom. Let me just read the description from you. Triplex, 1 mile from Pompano's beautiful public beach. Really nice neighborhood. Offers 2-unit with 2 bedrooms, 1 bathroom, 1-unit studio, nicely maintained. Owner has leased yearly, monthly, and weekly. So that is why I'm actually gonna analyze this as an Airbnb or as a kind of a weekly home sharing model to see what that looks like. So gross income varies. Owner currently self-manages and rents weekly up to $350. Again, we'll see how that impacts once we go into the Airbnb model. And then buyer to satisfy themselves on all square footage as is contract grade investment or occupy 1 unit, no long-term leases, a roof approximately 2003, proof of funds with all offers. So let's get right into it. The first thing, again, that we need is, now that we know what each unit, it actually doesn't say what each unit is rented for, but since I know that market area, I know that a 2-bedroom, 1-bathroom on average is about $1,400 a month, and a studio is about $1,000 a month. And also, it does say here that the owner rents weekly up to $350 per week. So that being said, $350 times 4 weeks is $1,400 for the month. So those numbers pretty much align with what we want to see. So the first thing we figure out is this income. So let's go down the cash investment column. Let's say you had a couple $1,000,000 lying around and you wanted to invest into something. This is what the numbers would look like in this scenario if you were to pay the $395,000 asking price. The income is $44,200. Now let me get into this section just so you understand. I am including vacancy here, and actually the vacancy I'm including is 1 month. So we had George that reached out to me on LinkedIn and asked me, hey Max, why is it that you only subtract 1 month of vacancy in this scenario? And let me explain to you why, okay? The monthly rent, when you add up $1,400 plus $1,400 plus $1,000, is $3,800. On an annual basis, if you take that $3,800, that's $45,600 of income. Now, typically, whenever I analyze larger deals, so anything that's pretty much 5-6 units and above, especially if it's like a 451 unit deal that we are currently analyzing, I usually include a 10% vacancy. In some scenarios, that vacancy might be a little bit higher. So again, I will present you more bigger deals in other scenarios, but again, we are focusing on one deal at a time, so just stick with me here. So in this scenario, if I was to think that, okay, I'm going to put in a 10% vacancy factor, on an annual basis, that's $4,560. What that tells me is every single year, the tenants would have to move out, so I would lose $3,800 in rent. I am assuming that you have a security deposit, and ideally, if those tenants move out, any damages that are done by those tenants would be covered by the security deposit. And again, I would lose a month of rent because those tenants have moved out, plus another $760. So in this scenario, based on the way that I would analyze this for me personally, I'm saying, okay, look, I don't expect to have that much turnover because these are market rents. I know what's going on with the market. It's only 1 mile away from the beach. So I'm going to go ahead and say one unit at the $1,400 is going to empty out maybe one every time 1 year. So that's why I subtracted the $1,400. You can analyze this deal any way that you want. Actually, if you want a copy of the deal analyzer, which we have it in a nice Google spreadsheet, and then you can download it as an Excel, play around with all these numbers. It's actually in the description. You don't have to enter your email address, none of that nonsense. Just go and download it, play around with the numbers. Heck, put whatever numbers you want. If you want to use 30% vacancy, go ahead and use that number. So again, I am using a vacancy factor here. Then we have taxes, $5,241. Insurance, $3,000. That's an estimate number. It's not disclosed what is here. Water and sewer, I'm saying, okay, about $150 per quarter, so about $50 a month per, for what's happening in the whole entire building, $600. Landscaping, again, it's about $800 for just exterior maintenance. Electric is $0, and then again, I left this as a placeholder when we do the Airbnb. So in this scenario, the tenants are all paying their electric. Repairs, there shouldn't be much done, about $800 for the year, etc. So then we get our expenses, which equals $10,441 when you add up all of these numbers. There is no financing. Remember, we're looking at the cash deal, which means our net operating income, which is just our income minus our expenses. Our net operating income is $33,759. Again, the cap rate. How do we figure out cap rate, capitalization rate? All it is it's a relationship between your NOI and your purchase price. So the purchase price in the scenario was $395. Take $33,759, divide that by $395, we get a cap rate of 8.55%. Today's date in South Florida, the average cap rate is between 5.5% and 6%. So, when you look at this number, it is above average. Now, let's go into the next section, 20% leveraged investment. Again, the income here is exactly the same. I'm taking out this vacancy. All of our expenses are exactly the same, $10,441. The number that we are adding in is our annual debt service. How do we figure out our annual debt service? Pretty much, if you take 20% down payment, which is $79,000, and you take a mortgage on the remaining amount, your monthly principal and interest only payment is going to be $1,508.63. Take that number, multiply it by 12, annual debt service, $18,103.59. Again, the NOI is just the difference from our income and all of our expenses, including this debt service, $15,655.41. Now, the term that we are using here is what's called a COC, cash on cash return. What does that mean? That means that we took 20% down. The money that we put into the property is $79,000. So that's our money in. On an annual basis, for what we have here based on our income and our expenses, $15,655.41. So the relationship, when you take that divided by the 79,000, that is 19.82% cash on cash return. Again, for all of my more experienced investors, and if you're a syndicator, we try to look for anything above 10% cash on cash return. So again, this is above average. Now let's take a look at owner occupied. Owner occupied, really there's a couple of differences here. So the difference is that because you're using an FHA loan, you have to live in one of the properties for at least 2 years. So what's going to happen here? I'm saying, okay, you're going to live in one of the 2 bedrooms, 1 bathroom, so you lose this $1,400 of rent. On top of that, I'm still including a vacancy of $1,400. So when you take $1,400 plus $1,000, multiply that by 12, and then subtract 1 month, the $1,400 of vacancy, you get $27,400. On the expenses, most of the expenses are the same. The only thing that I'm saying is the landscaping number, because you live there, hey, you're gonna have to do some work. So you're gonna save that $600, and also the let's see, the electric number is 0 here. The other number was repairs. Because you're living in one of the units and hopefully the other units are in good condition, I lowered that number to 400, trying to be a little bit optimistic here. So again, the expenses, as you see, they're about $1,200 less expensive here. So that's $9,241. And then our financing, again, because we're only putting 3.5% down, which is $13,825 to acquire a property that's a mile away from the beach, that's a cash flowing, cash income producing property, $13,825 in. That makes our principal, interest, and our PMI, your private mortgage insurance, $2,137.43 for the month, times 12, gives you the total of $25,649.20. Our NOI, again, it's our income minus all of our expenses. That number is negative. So what does that mean? Negative $7,490. You as the owner occupant have to put out of your pocket every single month $624.18. Now that might look like a good deal to you, but again, for all of our Kingdom citizens and all that understand velocity banking, this is where things get exciting. As of right now, if you live in Pompano Beach in a 2-1 and you're paying $1,400 of rent, you would be paying $1,400. Now you're only paying $624. So the difference of that is actually a cash flow that you have on your personal finances. So now all of a sudden you have $775.82 extra, okay? So because you have now cash flow and you have this number, instead of paying $1,400, you're only paying $624. That means you could use this number for velocity banking to pay off debt much, much quicker. And again, if you want to learn about that, Denzel is the expert on that. Go and check out his channel and you'll see how this number affects that. So that's huge right there, okay? $775 and extra monthly cash flow is huge. Trust me, that will make a difference in your finances and how soon you pay off debt. Now, let's take a look at this scenario. I'm coming in with an offer price at $370, and you might say, hey Max, why are you trying to knock off $25,000? Because again, we have access to information. Check this out. 300 Southeast 9th Ave. So this is 317 Northeast 12th Ave. So Southeast 9th Ave is actually just a few blocks away from this property. That property sold on August 29th, 2019, so just 4 or 5 months ago, for $365,000. And it was also a triplex. The layout was pretty much very similar, and it was in fairly good condition, fairly same condition. So to say, hey, that property sold for $365,000, why would this property sell for $395,000? I don't get it, so I'm going to offer $370,000, right? Again, the other information that we have is, check this out. I know that this seller took out a loan. They have a mortgage recorded on the property March 11, 2019 for $180,000 at 4.4% interest with a 30-year term. So again, knowing that they have a mortgage, I don't know if they're desperate to sell because they took money out just in March of last year and now they're trying to sell the property. So are they retiring? Are they moving? Or do they have other money problems that's going on? Again, all of this stuff leverages for you as the buyer to kind of figure out what you want to offer, right? So check this out. Our cash NOI, again, the numbers as far as income goes stay the same, right? The expenses stay the same. What changes here is our offer price. So our cash NOI, as you see here, is $33,759. In this scenario, it was exactly the same number, $33,759. Our cap rate now, because we're putting in $370 instead of $395, goes up from 8.55% to 9.12%. Again, as I told you, the average right now in South Florida for cap rates is between 5.5% and 6%. So 9.12 is way above average. Again, with a 20% leverage, let's see what that looks like here. Again, your down payment is $74,000. Your monthly principal and interest, $1,413.15. So once we do all of that stuff, take our income and subtract our expenses and our debt service, we have $16,801.21 left over. Now, remember, our cash on cash is our NOI divided by our down payment. So again, we only put in $74,000 into this property. So our actual cash on cash is 22.70%. Again, I know the guys that are syndicators and our seasoned investors are jumping off their screen and saying, hey, I want a piece of that. Find me a property that has, 40, 50 units that has 22.70% cash on cash return, and I'm all over it. Trust me, I am myself as well. Now, let's take a look at this scenario, okay? And this is where it gets even more exciting. 3.5% FHA loans. Again, our NOI is still negative, so we're still coming out of pocket, right? Our down payment here is only $12,950, which means our out-of-pocket on a monthly basis is $340.13. Again, remember, cash flow. You're living somewhere else, paying somebody else's rent, paying down their mortgage, and you're paying $1,400 a month. Now you buy this property, you own this property, you have tenants living there, you have cash coming in, you have to put a little bit out of your pocket to make sure that you pay your mortgage, your taxes, your expenses, all of that stuff, right? But remember, your out of pocket is only $340.13. So you went from putting out $1,400 to now only putting out $340. So your actual cash flow now is $1,059.87. And again, for the velocity bankers, the kingdom citizens out there that like to do velocity banking, that understand this concept, this is huge, right? It's a huge number, $1,059 that you could save every single month and put it towards paying down other debt using velocity banking. This is powerful stuff. So let's get into Airbnb. Before I jump into it, again, if you want us to analyze any of your deals, you don't have to send me your address. You don't have to send me the MLS number. We just need three things. The listing price, okay? Whatever your income is. So if you say, hey, I have 4 units, this is what it is on a monthly basis. And then your expenses. If you send us those numbers, I'd be more than happy to analyze it for you, put your scenario up on the board. And then again, even if you have an offer price and you want to say, hey, I'm thinking of offering whatever, $370 because the property down the street sold 2 months ago for whatever, $350. But now the market has appreciated a little bit, so I'm thinking $370 would be a fair value. Based on that, we'll put your numbers on the board and we'll tell you exactly what that looks like. Now, because this property is a mile away from the beach, let's look at the Airbnb scenario. And then after we look at the Airbnb scenario, I'm actually going to look at the Airbnb scenario in both ways. We're going to look at the listing price of $395 and we're going to look at the offer price of $370. And then at the very end, I'm going to put all of them together and I'm going to say, okay, this is what the $395 rented out as individual units looks like. This is what it looks like with Airbnb. This is what the $370 with the individual units, and this is the $370 at Airbnb. So let's go ahead and jump into the Airbnb scenario. All right, so now let's jump into the Airbnb analysis. And why are we doing this? Actually, it says right in the property description that the owner is actually already renting it out on a weekly basis, and the income varies, all of that good stuff. So it's also a mile away from the beach, east of 95, closer to Pompano Beach. So it's a great opportunity here. So the first thing that we do, let me show you just how we went and analyzed this using actual Airbnb. So what we actually did is I searched Pompano Beach, and I searched for a week rental between June 14th, 2020 and June 20th, 2020. So this is, today is January 16th, so this is actually 6 months away. Now what it's telling me is $52 per night times 6 nights is $313. The cleaning fee is $40, which goes directly to the host. The service fee is $46, which is what Airbnb keeps. And then you have occupancy taxes and fees that goes to the state of Florida for $46. Again, the $52 times the 6 nights was the $313. So that's actually the number that I have here as the low season, $313. Now, I also searched from November 15th, 2020, so almost 11 months out to November 21st, 2020 is actually $110 times 6 nights is $660. And then again, the cleaning fee goes to the host, the service fee goes to Airbnb, and then the occupancy taxes and fees goes to the state of Florida. So the number we're using is the $660 because all of this other stuff is essentially expenses. So essentially I say, okay, the high season week is $660. Now, what did I do here? This is probably not the right approach because, again, you probably have here in the state of Florida, our low season is really only about 4 months. So a more accurate thing would be to actually take this and multiply it, average out these two, multiply times whatever, 66% or, 70% versus the actual just half. So again, but this average, I just took this number, the low week plus the high week divided by 2, say, okay, my average is $486.50. Again, all the cleaning expenses, all that other stuff, none of that's included. The net 3%, again, Airbnb charges you a fee of 3%. So then I subtracted 3% from that number, which gave me $471.91 for the week. So stay with me here. There's a link below where you can actually check to see what the hotel occupancy is. And again, this is just a statistical site that averages out and is telling you what the occupancy rate for hotels has been. Average speaking for the last year, for actually the last 5 years, if you look at the averages, the occupancy rate is actually 60%. If you Google occupancy rate for Airbnb or home sharing, you'll actually see that it says the majority of the users get about 65%, and anywhere that's above 65% is actually considered, an outlier, so don't use that number. Here we went with 60%. If that's what the hotels are getting, I'm gonna go ahead and use that same thing. I don't know about you, but the annual weeks, I believe it's 52 weeks per year, so I took that. And then I took the occupancy of 60% times the 52 weeks, since we're looking at weekly rental, we get 32 weeks. The actual number is like 31.8 something, but I just rounded up to 32. So let's see what this looks like. Again, if we're gonna rent this out for the Airbnb, I'm not considering that the 2-unit is gonna be rented out more than the studio, none of that stuff. I'm just saying, okay, it's a unit, and I'm gonna rent it out at $486.50 on average for the 32 weeks. So what does that look like? Let's go ahead and say, okay, at the listing price, which was $395,000, our income, again, is $45,302.88. And how did I get that number? Again, I just took this 32 weeks, multiply it by my net weekly fee of $471.91. This number, again, because I rounded up, it's actually multiplying by 31.8 something. So again, this number is what this reflects. All of my expenses are gonna be pretty much the same except of one. I am gonna have to pay electric here. So again, this number for electric, I'm figuring about $100 per month okay, is what's gonna go in to pay for the electric bill here. So that's $1,200 for the year for the whole property, right? So the expenses jump up a little bit, $11,641. The NOI in total is $33,661.88. What does that mean? Previous to that, our NOI was $33,759. So in this scenario, based on that, you'd actually get more money renting it out to a renter with a monthly contract at the rates that we showed versus doing an Airbnb model. And again, I don't have property management here. I'm not sure how, what your service fee are going to be for your cleaning fee with a cleaning company that you decide to go with. So, these numbers, the NOI might actually be lower. So based on that, our cap rate is 8.52% on a cash deal, where previous to that, it was 8.55%. So looking at this here, as a cash investment, it probably makes more sense based on numbers to rent it out on a monthly basis on regular tenants versus doing the whole Airbnb, managing people going in and out, managing the booking, getting the phone calls, the Wi-Fi doesn't work, all that good stuff. But nevertheless, I'm not going to opinionate on my opinions on Airbnb. That's up to you to decide whatever you do. I will say there is one scenario where Airbnb works beautifully here, but let's get into it, all right? Don't get desperate. So next, again, we're looking at the leverage model. Again, everything is the same. The income is the same because we have all 3 units rented out. The electric bill now is included, so our expenses are a little bit higher. We have the annual debt service on the $395,000, which is $18,103.59. And our NOI here again is $15,558.29, which gives us a cash on cash. Remember, this number is divided by your down payment of $79,000. So in this scenario, your cash on cash return is 19.69%. Again, for the more experienced investors and the syndicators, this number is still looking very, very good, just in general. But again, in the previous scenario where all the units were just rented out, we had about $7 more in annual cash flow, and our cash on cash return was 19.82%. So again, I don't know about you, but when you compare those numbers, it actually works better the other way. Now check this out. I did say there was one scenario where this works out beautifully, and check this out. The owner occupied, right? So again, in the owner occupied, I assume that you're gonna live on one of the 2-bedroom, 1-bathroom units. So that's why this income is actually much lower than the $45,000 that you see here. Again, we're going with a 60% occupancy rate, just like the hotels. If you're able to get 90% occupancy rate 1 year, you're going to do amazing. These numbers are going to be completely different. But again, I wouldn't suggest that when you're doing an analysis that I would go that, optimistic. I would be more on the conservative end, and the conservative end is kind of going with the trends here and using some realistic numbers. So again, on the owner side, because you're actually living on the property, you're gonna save on the landscaping, because I assume you're gonna be doing it yourself. And the other thing is the repairs. I assume you're gonna be doing a little bit of repairs yourself. So in this scenario, we had 800. In this scenario, you had 400. And again, because you're living on the property, you're managing all that stuff. So in this scenario, you could see that the income actually goes up. And why does it go up? The reason that it goes up is, again, because on the other unit, remember, you were only getting $1,400 for the 2-bedroom, 1-bathroom, and for the studio, you were only getting $1,000. So now you're actually getting on average about $471 per week. So that's why the previous income was $27,400. Now it's actually $30,201.92. So in the owner-occupied scenario, the income looks better. The expenses are pretty much, it goes down by $1,200. The debt service is exactly the same. Now our NOI is actually negative $5,888.28. Divide that by 12. Monthly out of pocket as the owner occupant, you're putting $490.69, where before this, in the previous example, you were putting $624.18. So as an owner occupied at the price range of the $395, this actually looks pretty good. Again, as I explained, the monthly cash flow, if you were paying $1,400 in rent and now you're only paying $490.69 to complete the payments for what it takes to carry this property, your actual monthly cash flow is now $909.31. And again, using Velocity Banking, you could use that to pay off debt much, much quicker, where again, previous to this, it was only $775. So again, in this scenario, as owner occupied, the Airbnb actually looks really, really good. Now, let's look at our offer price, okay? Our offer price, again, because at what we looked at the other unit that sold back in August, we are gonna go ahead and offer $370. Now again, the NOI is exactly the same. The only thing that changes here is our cap rate, because our offer is different. Remember, cap rate is just the relationship between your NOI, which we established here, $33,661.88, but now our purchase price is $370 instead of the $395. That's why our cap rate actually goes to 9.10%, where here was 8.52. But again, in the previous example where we had a higher NOI, even though our offer price is less, our actual cap rate on the previous example was 9.12. So again, on a cap rate basis, this was actually a better deal if you rent it out, and then you don't have to do all of that stuff. Now, if you have a great year and instead of having 60% occupancy rate, you have 80% or 90%, well, of course, your cap rate is going to look much better. But then again, some of your expenses might also be higher, so it's all kind of relative. On the 20% leverage, again, it's funny how it all kind of relates and it works out differently. The NOI in this scenario was $16,801, and now our cash on cash return is actually 22.70. Why? Because our down payment of $370,000 is only $74,000. So again, in this scenario, your actual cash on cash is 22.70%. where in the previous scenario, rented it out as a monthly rental, it's 22.57. So again, if you have a very good year and your occupancy is higher, that cash on cash scenario is also going to be higher. But now let's take a look for the owner occupied, and this is very exciting here. The FHA again is only 3.5% down payment. Now our NOI is still negative, so you're still out of pocket. For the year, it's $2,479.67, okay? So why is that? Again, it's because your monthly payment is less. Your monthly payment is almost $400 difference, okay? So what does that mean? Out of pocket on a monthly basis as owner occupied doing Airbnb, renting it out for 32 weeks of the year, the other 20 weeks, whatever, you don't have to rent it out or whatever, go on vacation, do something, right? So you're paying $206.64 out of pocket. In the previous scenario, it was $340. So again, now you even have more cash flow. If you were paying rent $1,400 somewhere else, now you're only paying out of pocket $206. Your actual monthly cash flow is $1,193.36. And again, go and check out Velocity Bank. And I know when Denzel sees this and some of our Kingdom citizens that see this stuff, they're going to be super excited because this is going to make complete sense. Once you understand Velocity Banking and the power that you have to look at your personal finances like businesses do and say, hey, I'm already paying $1,400, $1,600, $2,000 in rent. When I look at my monthly output, you know, what I have income coming in minus the output I have going out, the difference in those two numbers is just cash flow. So again, if you were paying $1,400 that was going out anyways, and now you're only paying $206, you're actually increasing your cash flow by that $1,193.36. Again, this is huge right here, okay? Huge potential with this property, with the Airbnb. Again, look at the numbers that I'm showing here. This is just based on a quick search. This is just based on these numbers. Again, you could analyze this in multiple ways. You can use, instead of using the average, you could say, hey, you know, 75% of the time, I'm going to be closer to here. 25% of the time, I'm going to be closer to here. It's going to give you a different number that's going to be higher here. Again, the occupancy rate, I would not suggest that you go above 60% because that's just the average. If you have an awesome year, if Florida, like we have this year, the Super Bowl is going on, it's 2020, more people are traveling, more people are retiring, Florida's economy is booming, you have more business visitors coming in, you have more people vacationing, maybe Airbnb is becoming more and more popular, people actually want to stay in these homes instead of staying at a hotel. And again, if you look at the hotel, a nightly rate at some of these hotels is well above $200, on the beach. So if you could be a mile away from the beach, maybe bike to the beach or walk, or you have college students during spring break or all this stuff, the $313 sounds very, very reasonable. Even this $660 is $110 per night. You're still half price of what you're paying on the beach. So again, I think these numbers on average look very, very realistic. And again, if you do all of this stuff, if you do all the math, again, it just makes sense. So this is why I'm excited to create these videos. And I actually wanted to do this Airbnb example as a scenario for some future deals that I'm going to be presenting to you that actually use the Airbnb model in pricing out how they're actually structuring their deals. Now, some of the models that we are going to look at in the future, they're actually not going to qualify for FHA because remember, FHA has limits, okay? Every county, you can go to HUD.gov and there you can enter your zip code, you can enter your county by where you live, and it'll actually tell you how much is the maximum for a 1-family, maximum for a 2-family, maximum for a 3-unit, maximum for a 4-unit, and then based on that, you'll know, hey, this qualifies. Once you get, for example, in Pompano, I believe a 4-unit, the maximum is $768. One of the units that we're going to look at that has the Airbnb model, it's only 3 units and it's priced at like $1.9 million. So again, that number for FHA definitely does not work. For conventional, there are loans available that you could do that, and obviously in the cash scenario, we'll present it in this very similar way. But again, what I want you to focus on is start putting your investor cap, start thinking about monthly cash flow. I'll tell you, I'll be honest with you, if I would have known about velocity banking back in 2011, I would have 5 times, 10 times the number of units that I own today. So again, combining this, understanding how to analyze real estate, understanding that you're gonna live somewhere, that you're gonna pay rent somewhere. So why not pay your mortgage? Why not pay less in your mortgage? Because you have cash flow coming in from the other rental units and also build up your portfolio. Again, as I mentioned, one of our future series is going to be my wife and I. We're going to come on here. She's actually a tax planner, a tax professional, and she's going to be telling us, explaining to us what some of the advantages are. For example, a 1031 exchange, how you were able to do cash out refinance or a home equity line of credit in order to take that money and invest into other real estate, and the very, very powerful tax savings that real estate offers you. So again, get excited about this stuff. We're more than happy to help you. Send us whatever you have. Like I said, don't send me your address. Don't even send me the state. Don't even send me anything. Just send me, I need 3 numbers to put your deal on this board, get you to, so you could see your deal on the board, say, hey, what would Maxim think? How would he analyze this deal? Am I too low on my expenses? Are there some things that maybe I'm missing? I'll be more than happy to put it up on the board. All I need is 3 numbers. The listing price, okay? Your income. So all of the units, if it's a 4-unit building, what each one of those units are going to be rented for. The expenses, things like taxes, insurance, water and sewer, landscaping, if there's common electric, if there's common gas, if you're up in the cold states, if you have some plowing, if the roof is more than 10 years old, my repairs number might be boosted up a little bit here. And again, for those that don't know, I actually went to school for architectural engineering. I worked as a civil engineer. Then I started my own construction company. We built a couple of homes. We did some commercial work as well. And then I got out of that industry in order to go into real estate full time. And I just love multifamily investing. And now this is what I do here in Miami. I work with buyers and sellers looking for multifamily properties. A little bit bigger deals, you know, on the 20 to 40 unit on average. Like I said, the biggest deal we're analyzing right now is actually 451 units. But nevertheless, this is how you start. This is how I got started. So what I want to show you is, hey, you know, a tax season is coming up. There's got to be plenty of people in the United States that are going to have $10,000, $12,000 lying around. Why not make an investment in something that makes sense and something that you're going to earn, you know, own, something that's going to actually build your net worth, because real estate builds net worth. It's an asset, you know, as Robert Kiyosaki explains it. Again, you are owning a piece of property, you are taking on debt, but that debt, the majority of it is being paid by the rental income. So focus on that. Focus on this number, what your monthly cash flow is. How much are you putting out of pocket? How do you go from paying $1,400 in rent to reducing that number to whatever, $500, or in this scenario, $206? You know, that's what I want you to get excited on. Leverage the power of the FHA. Who cares that you're paying PMI? You know, look at the numbers. Doesn't it make plenty of sense that, hey, I'd pay PMI for 30 years if I had the ability to reduce my rent? And guess what? If you're only paying $490.69 out of pocket, when you move from the property 2 years from then, what happens? If you rent out that unit for $1,400, which heck, in 2 years the rent better not be $1,400, it better be at least $1,425 or $1,450, you know, then all of a sudden you're cash flow positive. That property is actually paying you back, okay? So then what happens? If it's paying you back, look, I'm just gonna do these numbers right here on the board. Let's say, you know, your monthly expenses right now, just to do numbers simple. So out of pocket to complete your mortgage and all of your expenses is $500. Now you moved out of the property and you've rented it out for $1,425. Check this out, right? $1,425. You lived there for 2 years. So for 2 years, you've been saving about $900. So 900 times 24 months, 9 times 12 is 78. 78 times 2 is 15,600. And sorry, if I'm wrong on this number, sorry. So you've saved, not theoretically, practically, I know because I experienced this stuff. You've saved over 24 months, $900. So if you use your money correctly, if you're saving that money, or if you're doing velocity banking, this is how much you're able to chunk. This is how much you're able to pay off additionally versus if you were in the same scenario, right? So again, now you moved out of this property. For you to pay that $500, now you're getting $1,425 of rental income. So that leaves you with what? That leaves you with $925,000 positive every single month, right? So now all of a sudden, $925 times 12 every single year, you know, that's, what is it, 10,000. I just got to do the numbers on my calculator. I'm breaking my leg here. As you see, you don't have to be good at numbers. Use a calculator, right? That's why we have these tools. Oh, look at this. I was completely wrong. 900 times 24 is 21,600, okay? Now in this scenario, 925 times 12 is 11,100, all right? 11,100. Now think about this. You've lived at the property for 2 years. You have practically saved $900 a month, okay? Because your out of pocket is only $490, not $1,400. So over a 2-year period, you've practically saved $21,600. Now 2 years has gone by. Guess what happens? You've paid down some of your principal. It's not a lot, but you've paid down a little bit of it. And your tenants help you pay the majority of it. Now you move out of the property. Guess what? Now you're cash flowing on an annual basis an extra $11,100. Not only that, if the property has appreciated, so now you have equity in the property, you've paid down some principal, all of a sudden you do what's called a HELOC, okay? Home Equity Line of Credit. You do a HELOC, $75,000, $100,000. Now Now you're a serious investor, right? Now you have $75,000, just like you need here, to take that money out and put it into another property so you could start cash flowing, and now you can look at your cash on cash. Now this is what you can measure, right? So again, this is the possibility. Not only that, but taxes. Oh my God. People don't understand taxes are the biggest expense that we have here in the United States. When you look at depreciation, guess what ends up happening? Let me just do this. 900 times 12, it's very close to this $11,100. Now, if you use depreciation, residential depreciation is 27 and a half years. So if I buy this property for $395 times, divided by 27 and a half years is 14,000. Check this out, $14,363. That is my depreciation for tax purposes. Guess what happens? My income on this property was $11,100. My expenses, okay, my expenses was all that stuff. We're already figuring all that stuff in there. Minus depreciation is $14,363. So you actually have a negative number which you can carry forward. Again, my wife is the expert. She handles that part, but this is what I understand. You carry forward that number. So you got this $11,100 pretty much tax-free in your pocket. I mean, come on, how good of a deal is that? Then you do a 1031 exchange, and whatever taxes you might have had to pay for capital gains, you defer it for the future. Like, is this starting to make sense why real estate makes the most millionaires of the United States? Because it's one of the best tax havens. It's one of the best asset classes. Look at the cash on cash return. Look at the possibility of what happens in 2 years. Man, this gets me exciting. I feel like I want to go out and buy this property and do this thing myself. So with all that, hopefully you enjoyed that. Again, Maxim Cruz here. I'll be more than happy to put your numbers on the board. I'd be more than happy to refer you to any real estate agent, specifically in your area, in any place in the United States. And again, we are here to help you. Get excited about real estate. Start investing. Don't be afraid. Learn what you need to learn. Save up your down payment. Get into it now, okay? Stop waiting. Another year is going to go by and you're still going to be studying. Get into this, all right? With that, have an awesome day, and I'll see you on the next video.